Hey everyone, welcome back to another dividend investing video. Earnings season is underway as volatility has continued in the month of October. But one thing as dividend growth investors we can predict is that if we stick with high quality companies that have the track record of consistently growing their earnings, free cash flow, and dividends paid to shareholders, we can rest assured that the passive income stream from our dividend accounts will continue to grow regardless of what the markets are doing. And today I'm highlighting 3 companies that definitely fit this bill, who just raised their dividend payments here as we close out the month of October. Now, are these stocks a buy today is the question. And well, in today's video, I do hope to provide some clarity, and stick around until the end where I'm going to cover some additional news and updates around a few other popular dividend stocks. So let's get into it. I'm Nick, and this is the Dividend Growth Income Channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. Stock number 1 is ABBV, Inc., ticker ABBV. ABBV is an American pharmaceutical headquartered in Chicago, Illinois. It was spun off from Abbott Labs about 10 years ago and has continued the long tradition of Abbott, raising its dividend every year. On October 27th, ABBV announced it was raising its dividend by nearly 5%, maintaining confidence in their outlook after losing exclusivity to their flagship Humira drug line, which accounted for 40% of their overall sales. They also reported an increased profit outlook and boosted guidance. However, shares dropped 5% on the news. So could this drop signal an opportunity for long-term investors? Well, let's look at its recent performance. Shares have fallen 9% in the last month, so the stock has been in a downward trend even before the news of today came out. Now, year to date, shares of ABBV have fallen 14%. Despite this, I personally do not think this stock is cheap, quote unquote, by any means at all. But this brings me one of my favorite Warren Buffett quotes about investing. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And ABBV has been an absolute beast for investors, nearly doubling the return of the S&P 500 over the last decade on a total return basis, with a total return of over 346%. The PE ratio is 12.7, so while it's not a high PE ratio, it's considerably higher than ABBV's 5-year average PE of 9.3. But also consider the median PE of the healthcare sector is at 16.7, and ABBV still falls nicely below that value. Now, today's shares are yielding 4.46%, and this is about 7% below the 5-year average. It's getting closer to being in fair value territory, at least in terms of dividend yield theory. And ABBV has a track record of paying that dividend for 51 years, and if you add its history as part of Abbott Labs into the picture, and the S&P 500 Dividend Aristocrats Index does give ABBV this credit, and so we will as well for our purposes. Dividend growth has been slowing over the last couple years, with this latest one at 5%, and last year's raise was similar. ABBV has a 5-year CAGR of 17%, that average annual dividend growth, and I think single-digit dividend growth is what we can come to expect for the foreseeable future, at least until their next breakout. But there is a pipeline. For example, ABBV is developing a drug for Parkinson's disease that they expect to be a blockbuster potentially in 2027. There's some amazing potential there. And hey, that could help out a lot of people in the process. And look at the payout ratios. We have at 54% of forward earnings and 53% of the next 12 months of free cash flow. So this is not high for most companies, but it's right at that borderline for a biotech company. But overall, it's in decent shape. Simply Safe Dividends gives ABBV a dividend safety score of 70, rating it safe, unlikely to face a dividend cut. The score is on the lower side compared to other pharmaceutical companies, however, such as Pfizer, Amgen, Merck, and J&J. They all have higher scores than ABBV. Now, that dividend is paid out in the months of February, March, August, and November, paying $1.55 per quarter per share for a total annual payout of $6.20 per share. We have an average analyst price target of $166.53. This represents 20% upside from where shares trade today, and that would put its share price back around the 52-week high. It's entirely plausible. I also think short-term, ABBV could go down some more. It's still a little on the pricey side in my opinion, but a quality dividend growth stock nonetheless, and I'm happy to be a shareholder. Now, today I would rate ABBV stock a hold. it would need to drop some more for me to want to add to my own position. All right, the second stock we're talking about is ExxonMobil, ticker XOM. ExxonMobil, I'm going to call it Exxon, is a multinational oil and gas corporation, a direct descendant of John D. Rockefeller's Standard Oil, a dividend aristocrat, one of the world's largest and most influential companies. In October 27th, Exxon announced it was raising its dividend by about 4.5%. Furthermore, earlier this month, Pioneer National Resources, ticker PXD, announced it had reached an agreement to be acquired by ExxonMobil, and its shareholders will be receiving 2.3234 shares of XOM for every share they own of Pioneer. This is expected to go down in the first half of 2024. Pioneer Resources is an independent oil and natural gas exploration and production company in West Texas. Shares of Exxon are down 10% in the last month, while year-to-date shares are practically flat, down just under 1%. And over the last 10 years on a total return basis, ExxonMobil's total return is right around 80%. That includes all dividends paid, and in actuality, most of this return is in the dividends. Exxon's share price is only about 17% higher than it was 10 years ago today. And the total return is less than half of what the S&P returned in that time frame. But like many of Exxon's investors, they're in this primarily for that dividend income. Today, shares of ExxonMobil are trading at a forward PE of 11.1. This is a bit below its historical norm. It's also a tad below the median PE of the energy sector. But remember that oil stocks are pretty tricky to value because there's a lot of outside factors involved, like the price of oil. Now, shares are yielding 3.6%, and this is 25% below the 5-year average of 4.78%. So Exxon on average yields around 5%. That suggests that today is not likely the best time to get into Exxon stock, and investors could opt to wait until they can lock in a better starting yield for ExxonMobil. And we're talking a dividend growth track record of 141 years of paying dividends without interruption, and that is mind-blowing to maintain something like that. And the dividend has gone up every year, year over year, now for 41 of those years. And ExxonMobil is an elite dividend aristocrat. The dividend, while it doesn't raise at a super fast rate, is pretty consistent in that 3 to 4% range. And the dividend takes up 39% of forward earnings, 40% of forward free cash flow. These amounts hit right at that preference where you want to see for oil producers, so that's looking decent there. Simply Safe Dividends gives Exxon a dividend safety score of 80. It's rated safe, unlikely to see a dividend cut. And just remember that 141 years of dividend payments without a reduction, that's one hell of a track record. Now, Exxon pays out quarterly in the months of March, June, September, and December in the amount of 95 cents for a total annual payout of $3.80 per share. And the next ex-dividend date is November 14th, paying out on December 11th. Now, one thing we can say about ExxonMobil is their management has done a fine job reducing their debt with a net debt to EBITDA of 0.2 and a net debt to capital of 7%. These are both down greatly from historical norms, and the average analyst price target is $127. And that's a potential 20% upside from where shares trade at this time. So I'm not a buyer of ExxonMobil stock today, but there's no denying that it has its place as the largest oil company in the world by revenue. I would rate the stock a hold today for dividend investors, and I just wouldn't be looking to add to this right now unless it started hovering around that 5% average yield. Just under 5% really is where I would see maybe taking a position in this one. The third stock we're looking at is Visa, ticker V. Visa is a payment card services corporation that facilitates electronic funds transfers all over the world. It's one of the most valuable companies on the planet. They do not extend credit to customers, they merely facilitate credit transactions between customers and financial institutions. Today, Visa commands a 50% market share of total card payments. On October 24th, Visa upped its dividend by 16%, making for its 15th straight consecutive dividend raise. Let's see how the stock has done. Shares are about flat over the last month. Today, the stock is trading right around its 52-week midpoint. Year-to-date shares are up 10.5%. But what if you had purchased 10 years ago? Well, you would have made a 400% total return, more than double the broader market. Visa has been a long-term buy and hold winner. Visa shares don't trade cheap. The PE ratio is 23.2, and this is considerably lower than the 5-year average of 29.2. So by this metric, Visa is at the lowest valuation we've seen since the 2020 pandemic. mini crash and rally. Shares are yielding 0.91%, and this is 36% above the 5-year average, so another metric that makes Visa appear undervalued. And I'm going to illustrate why longer term, this doesn't matter if you are more than, say, 10 years out from retirement. In other words, needing your dividends to pay your bills. And if you have more than 10-year outlook, Visa is exactly the kind of stock I think you ought to be considering. Look at the dividend yield history chart here, and we see in the last 10 years, Visa shares have never been at this high of a current yield, even though it's a small yield under 1%. And to demonstrate why I think V is an excellent dividend growth stock despite the puny dividend yield, look at the yield on cost metric. If you had purchased shares of Visa 10 years ago, your yield on cost would be just over 4%. And that's not too shabby. This means dividends you receive, assuming you're going by the trailing 12 months, would be 4% of your initial investment, what you paid for your Visa shares. This is the long game, fellas. The earlier you start, the better, and the longer you can let these guys cook and compound, the better we will do. And this demonstrates that while Visa is not a stock to buy for income today, it could pay considerable income for you in 10, 20 years if you play your cards right. So it's all about where you are at in your own dividend investing journey. Visa has a dividend growth track record of 15 years. The dividend has been growing at a super fast rate, averaging 18% per year. And that's another characteristic of these lower dividend yield stocks is the growth rates are typically going to be in the double digits, giving you raises you're not going to usually get at your day job. And the payout ratios for both earnings and free cash flow are sitting below 21%. No concern here at all, really. And even more a green flag is that these numbers largely match up and have been more or less tracking each other over the last decade. Simply Safe Dividends gives Visa its strongest dividend safety score of 99, rating the dividend very safe and very unlikely to see a dividend cut. Visa pays out this qualified dividend quarterly at 52 cents every March, June, September, and December for a total annual payout of $2.08 per share. That next ex-dividend date is November 8th, and you'll need to have your shares before this date. Buying them on this date is not going to get you that dividend, so this really means buy them on November 7th or earlier to get the next dividend payment on December 1st. Earnings per share, free cash flow per share, they're up year over year. Every year, this is the sign of business firing on all cylinders. Visa has also been buying back about 19 to 20% of its shares over the last decade, going from 2.52 billion shares outstanding in 2014, and today there are 2.09 billion shares outstanding. Fantastic. I can go on and on. The company has virtually no debt, and it saw its sales increase during the last recession. The analysts have given Visa an average price target, $275.31 per share, and this represents 20% upside from where shares are today. Interestingly, all three companies you're highlighting have price targets in this range, and I didn't plan it this way. Visa, is my favorite pick out of the three companies I'm talking about today. Despite that lower dividend yield for investors who need dividend income today, I get it. Visa's not going to be what you're looking for. But if you're trying to build your wealth, Visa is hands down the strongest pick out of the three on this list, in my own humble opinion, and I would rate this stock a buy today. But that's just me. It's not financial advice. So let's look at a few other companies real quick. First, I'd like to highlight the dividend raise from American Electric Power, ticker AEP. This is an electric utility company, and they serve a large portion of the Midwest, and they have just upped their dividend by 6%. That's 13 years of dividend growth, 18 years without a dividend cut. AEP has a low payout ratio for a utility. Shares are yielding 4.7%. This is 36% above the 5-year average, so looking seriously undervalued by dividend yield theory, and I think this is a solid choice to consider if you're looking to up your exposure to utilities. And remember, Walgreens stock, ticker WBA, down over 72% in the last 5 years, just completely shit the bed. Well, they have announced a flat dividend for the 6th consecutive quarter. Let's see if they give a nominal raise here in the next quarter or two to keep their streak alive. This is nearly a dividend king, but look, with a massive drop in free cash flow per share and a Simply Safe dividend safety score of 30, I would not be buying Walgreens for that dividend. Shares are yielding 9%. That in itself tells you all you need to know. If you buy Walgreens, it's because you believe in their turnaround, not in the dividend for the foreseeable future. I predict they will have no choice but to cut this dividend if they want any chance of turning things around. Also, if you're an investor in Kellogg stock, now known as Kellanova, ticker K, they have adjusted their dividend lower by 6.7%, but worry not, Kellogg's investors should be made whole due to the recent spin-off of its North American cereal business into standalone company WK Kellogg, ticker KLG. A dividend announcement from that company should be announced in due time. Kellogg's also happens to make my favorite cheat day snack, Cheez-Its. Thank you all from the bottom of my heart for your continued support for my little channel here as we nearly hit the 20K sub mark. If you haven't subbed yet, what are you waiting for? And folks, if you are wondering about another dividend aristocrat that has fallen recently, talking about McDonald's, ticker MCD, go ahead and click into this next video where I do dive into that company, its stock, and its dividend, and I provide what I believe to be a fair estimate for McDonald's share and my own buy price for the company. I hope you'll check it out. And until next time, my friends, keep investing.